You know, I have no idea what I'm going to use for the title or the thumbnail of this video. There's so many important things we need to cover. I think this is a video that needs to be spread to as many people as possible. Some of the things we're going to cover here in this video is Morgan Stanley. They have the $400 price target on Tesla, the highest price target on Wall Street in general. They just addressed the Q3 miss of deliveries and some potential risks for Tesla, as well as their upside thesis. I'll tell you right now, they keep their $400 price target. It's not bearish by any means. You also have a potential breakout of Tesla stock, which I find this really interesting because Tesla looks really good on the charts. Things are going in the right direction for Tesla. But if you look at the markets, in fact, it's quite the opposite. The markets look very weak here, especially your Russell, your small mid-cap stocks, your high kind of growth risky stocks. Could be sending a bad warning for the broader markets. So we need to get into that. We also have a clip from Dan Ives. It's about 5 minutes long. We're going to play that as well. He goes over Q3 and this miss that Tesla just had. And I'm doing parentheses, air quotes here, because my estimate was 434,000 vehicles. Tesla came in at 435,000 vehicles. So Tesla exceeded my estimates. So I'm not going to call it a miss. This was widely understood to be around where Tesla was at, 235,000. But Wall Street obviously has delusional expectations. Now, we also had a lot of very positive option flows come in about the last half an hour of trading or so today in Tesla. So we have a lot to get into. We have important economic data coming out tomorrow morning and throughout the rest of this week that could really make or break our markets. So I hope you guys find value out of this video. If you do, hit the like button. Hit the like button if you also own Tesla stock, and also hit the like button if you want to better your future, reach financial freedom, enjoy Bahama Mamas on the beach or margaritas. I know that should be each and every single one of you, so there should be thousands of likes here on this video, but really hitting the like button helps push this video out to as many people as possible, and I think every Tesla investor really needs to hear this video. So I want to start with what's going on with Tesla, some of the option activity and the charts. Now, what was happening today, really up until the last 30 minutes or so of trading, was Tesla was right in between its 150-day moving average, this 100-day moving average being this orange line, this 50-day moving average being the purple line, and Tesla was above its 8-day moving average. So things were looking really good for Tesla, but Tesla could not quite get above that 50-day moving average. What happened? Well, Tesla's stock ended up soaring throughout the last hour or so of trading and closed above its 50-day moving average. Here in after hours, Tesla stock is $251.30. Your 50-day moving average, $251.06. So you're above this by 10 cents right now. And that might not seem like a big deal to a lot of people, but your 50, 100, and 200-day moving averages are by far the most traded upon moving averages by algorithms. Now, algorithms can control 70 to 90% of all of the trading volume on the markets. So important levels for algorithms are important levels for you to be watching as a Tesla shareholder. Now, I think we can also address the obvious. If there was any big catalyst that was going to send Tesla stock to the gulag, send it down big time, it was deliveries. Deliveries really set you up for earnings. So if you have bad deliveries, you're expecting bad earnings. Well, we just got deliveries, and they were okay. So earnings are probably going to be okay. There's not going to be any huge shockers, most likely, heading into earnings, and markets have a pretty good understanding of what Tesla's earnings are going to be. So that's probably not going to be a huge bearish catalyst. That could actually be a really bullish catalyst. But the next thing we have to look out for is the Cybertruck. So long story short, I'll save you a 5 or 10 minute long speech here. We really don't have that many negative catalysts to come for Tesla, unless Tesla does something that we cannot forecast, like cuts prices. Well, I just don't see any bearish catalyst. And Tesla stock could be about to break out into the 300 plus range. I've talked about this many times, and I'll reiterate it here again in this video. Stocks like a Tesla, in theory, should do pretty dang well in 2024. Well, why is that? Because if the economy is maybe not in a recession but not growing a whole bunch, well, your cyclicals, cyclical meaning it's cyclical to the economy, if those stocks are not seeing good growth, well, you want to buy growth. Tesla is offering you growth that no other big tech name is offering you. It's trading much cheaper than other big tech names. If you factor in this growth, it's 5 times cheaper than an Apple, with the same relative stability that you're going to find with other big tech names like a Google, Amazon, Microsoft, and Apple. Tesla is self-sufficient. They don't need to raise capital by diluting shareholders. If Tesla needs to raise capital, they go to the bond market. They go sell a package of leases. That is beautiful. That's exactly what you want to see. So I think for those reasons, it makes a lot of sense to buy some Tesla before 2024. Now, today was the first trading day of fiscal year 2024. And I think the kind of bullish reaction to this earnings deliveries miss that we've seen is telling you exactly that. Tesla stock is likely to be a really good stock to own in 2024. And I think once the Cybertruck is officially unveiled, which by some people's estimates could be 4 days from now, or at least the delivery event is announced, could be on October 6th. There's been a lot of rumors on that. Then I think that's where Tesla can have some momentum to really break out to a new high of this cycle. You also need to remember Tesla is by far the most under-owned large tech name out there on the markets today. There's not a lot of institutional hedge fund exposure in Tesla, and Tesla really didn't participate in the rally in 2023. Sure, you could say Tesla went from $100 to almost $300. Sure, but Tesla is still lower now than where it was in August of 2022, when Tesla was around $315 per share. So if I'm looking at Tesla and only Tesla, I have very bullish things to say, very good things to say. But if I look at the markets, it's quite the opposite. I have very negative things to say. The S&P 500 was down 0.5% today. Bond yields are soaring, the dollar's soaring. We'll get into that here in just a moment. But if you look at the S&P or the SPY ETF that tracks the S&P, you do not look even close to as bullish as Tesla. Your 100-day moving average is at 436. The SPY is at 430 or 427. You're $10 off of that. You are, on a percentage basis, 2% off of that. Your 50-day moving average, in which Tesla is above right now, is 3.5% of an upside move away on the SPY. It doesn't look nearly as good. The SPY is hanging out here at the lows. If you break under this line that we have here, connecting the lows so far, you could get into some pretty big downside. Around 416 would be your next stop of that 200-day moving average. If you did not find support there, you could fall all the way down to the 380 level. That just doesn't look good. You're not seeing a lot of strength in the broader markets. If you look at the QQQ, which tracks the NASDAQ 100, then you'll see a similar setup here. Although the QQQ is doing a little bit better than the SPY, the QQQ is still finding a lot of resistance and getting rejected at the 100-day moving average. If you fall under this line, in which has marked a couple of the most recent lows, then you could be in for some bigger downside down to about 330 on the QQQ. This does not look pretty, and I don't see a lot of near-term catalysts to push the markets higher. Today is a perfect example of that. Fed Jerome Powell 2 weeks ago during the FOMC press conference, and Fed speakers we have heard since then, basically reiterated the market's worst fear. The Fed said just blatantly, we haven't heard the Fed be this honest before, that even if inflation falls to 2%, if the economy is doing well, that's not good enough. Huh? What do you mean it's not good enough? That's your soft landing. If inflation goes to 2% and the economy is holding up, it's growing, it's doing fine, the labor market's fine, that's your soft landing. Fed Jerome Powell said soft landing is not his base case, meaning that he believes a recession is coming, and that you need to see weakness in the economy. It's a fine line between some weakness and a full-blown recession. Usually when you get some weakness during a Fed tightening cycle, it snowballs into a massive recession. Well, the data that we got today was ISM manufacturing PMI. This came out at 49. Anything under 50 is still contractionary. So you're still in contraction with manufacturing. The estimate was 47.8. So this data actually shows the economy is doing just fine, is doing well. Last week, we had PCE data that came out month over month at 0.1%. The estimate was 0.2%. So core PCE is falling faster than we expected, almost negative. Keep that in mind. And your economy is doing well. This should be great news. This should mean that the Fed's achieving its mission of lower inflation and not causing a recession. But what happened today? 10-year Treasury yields soared to a new high of this cycle, up 11 basis points today, and 2-year Treasuries soared about 5.5 basis points today. The markets tightened a lot based on this data report. Oil fell about 2% today. That's great news, but when you look at the yield curve inversion, you are uninverting at a rapid pace as the 10-year yield is climbing more than the 2-year and the 3-month yield. This historically only happens right before a recession. So we have a lot of weird things going on right now, guys. Some data points are screaming recession. If you look at the yield curve and the uninversion recently of the yield curve, that's saying a recession is coming soon. Whereas if you look at the manufacturing PMI today, that's saying the economy is just fine. I think this highlights something. No matter what happens, there's not a good outcome for equity markets, for stocks. Either you get a good economy and the Fed continues to raise rates to oblivion, or you get a recession. And that's not great for stocks either. So you want to be very careful here. This is a stock picker's market through and through. Some stocks could do exceptionally well. Tesla could do great things, could break out to new all-time highs next year, whereas the markets could do nothing or even fall. That's honestly my expectation. Tomorrow's economic data is going to be very important as well. It is the JOLT job openings. Now, like I said, there's a fine line between a softening labor market, a softening economy, and a full-blown recession. So you want to see data that is not good, like bad economic data, but not too bad, which makes this whole thing a mind-boggler. Let's just call it that. So JOLTS job openings have fallen a lot recently. You were over 10 million JOLTS job openings. Now you've fallen to 8.827 million. That was last month's reading. You're expecting, at least the forecast here on Trading Economics says 8.6 million job openings, and the consensus is 8.8 million job openings. So anywhere in that range, 8.8 million to 8.6 million, that's as expected. If you were to fall to like 8 million and 800,000 jobs are gone, that might be negative. That might be taken as, hey, the economy is slowing down a lot faster than we thought. So that's important data to be watching for tomorrow. And then on Wednesday, you have ISM Services PMI. This will be very important. A bunch of Fed speakers as well on Wednesday. On Thursday, you don't have much for economic data. You have initial jobless claims. This is on a week-by-week basis, as most of you guys are Tesla stock investors. Some of these UAW strikes might start to show up in this data, so we want to watch and see if that does happen. That tends to be more of a leading indicator. And then on Friday, we have the most important data, that is non-farm payrolls. You're expecting 170,000. This would be one of the lower numbers that we have seen recently. And the unemployment rate is expected at 3.7%, which would actually be a drop from 3.8%. So I think these are potential problems for the markets. Any of these data reports could turn a data report into a black swan event if they are really bad or potentially really good at this point. Neither of those is a good outcome here. You don't want to see really bad. You don't want to see really good. Even though inflation's falling, in theory, you would want to see a strong economy right now. But the Fed made it very clear, they'll just continue to raise rates. So be very careful. There's really no good outcome here. Now let's switch a little bit more into Tesla stock. Take a look at the option activity we've seen today. Now, if you guys watched the last video that came out at 4 p.m. Eastern Standard Time today, then you've seen this already. You had about 700 or so orders. These are individual trades. And you only had about $120 million comprising that 700 trades or so. Well, by the end of the day, you had 828 orders totaling $747 million. You've seen like $500 million plus head into Tesla options in the last half an hour of trading or so today. And you've seen what happened to Tesla stock. Tesla stock was not doing good at, the beginning of the trading day today. And we soared towards the end of the trading day. Now, the positive order value in the last video was 49%. On the day today, the positive order value ended at 56%. So even your miss, as analysts are calling it, on Tesla Q3 deliveries, you still seen very good orders for Tesla options, very bullish orders for Tesla's options. Whereas if you look at some of the other names that reported deliveries today, a Rivian was down 2.6%, NIO down 2.77%, and XPeng down 1.25%. And they all beat their estimates. So this really tells you something. People are bullishly positioning for Tesla in 2024. Now, take a listen to this clip from Dan Ives here on CNBC. It was about 5 minutes long. We're going to run the whole clip. I think there's a lot of information you should hear from at least the analyst side of Tesla stock. And then we're going to get into what Morgan Stanley had to say about Tesla today.
Let's bring in Dan Ives, Managing Director of Equity Research with Wedbush Securities. Great to see you.
Hey, great to be here.
Very, very busy times. You don't even know which piece of this to start with, and you've been quite clear about how bad you think this strike is going to be for the big three if they get what they're demanding. Is there any way in which Tesla also comes out a loser here because its workers demand more? It tries to unionize them or something to that effect?
Sure. I mean, there's always been a fear of unions at Tesla. I just see that as basically minimal probability that's going to ever happen. I think Tesla, it's a win-win situation because when you look at the big three, what's happening here, it's a debacle in Detroit because ultimately this is going to be passed to the consumer when eventually they do get a deal. And the EV strategy, I mean, this is a gut punch to borrow Farley, what they've built over the years. And I think that's really the frustration right now in this Rubik's Cube, where I believe the UAW deal, if they took that, it would essentially impair the business models for us in the next decade.
For the big three, that is. It will impair the business model because they'll be forced to pay so much more to the workforce that they will not be able to invest in the conversion to electric vehicles?
Exactly. I mean, if they actually sign this deal, I mean, these business models, the street would basically view it as an Everest-like uphill battle to ever be successful because it's ultimately one hand tied behind their back. They're going up against non-union Tesla, non-union Rivian, foreign automakers. And that's why right now, champagne on ice has been for Tesla in terms of the pending competition that's coming out of Detroit. And that's why this UAW, it's a nightmare on Elm Street in terms of what's happened in Detroit.
Why is it that Tesla's demand has been so soft? Is it simply that they've overproduced and they can't cut prices enough because there's just no pent-up demand additionally for EVs? And there's another. But why is it that those delivery numbers and that they have so much excess inventory right now? How long is it going to take for that to be absorbed?
So we think it's really fourth quarter. I mean, if I look overall, take a step back, if you look at 1.8 million, what I believe is going to be deliveries for the year, that's a super strong number relative to the environment. I think margins trough, and Phil's talked about that as well, Q4, I think you have Cybertruck that starts production, a refresh of Model 3. And I think in China, they actually start to gain more share. That's why, in our view, this is more of what I've used a pause into the next phase of the Tesla growth story, which is why we've been telling our investors here, you continue to own this name.
How did they go from not being able, a year ago, not being able to meet demand to the situation where they are right now?
Yeah,
what happened?
Look, demand definitely softened. We've seen that in China in terms of essentially a price war that's happened in China. But I believe the poker move of cutting prices, that was the right thing. I think we've seen it in the stock in terms of stimulating demand for Tesla. But no doubt, they are definitely going through a transition in terms of what we're seeing with demand in the U.S. globally. But if you look at scale and where we believe they could get to production, we're going to be looking at next year or two a company that's going to be 2.5 million, ultimately in the 3 million, what they're going to see from a delivery as well as a production. I think this is just, Tyler, in my opinion, this is just what I'll call the middle phases of the next phase of the Tesla growth story taking place.
I wonder, though, about competing with BYD. I mean, they have more models. They update them more quickly. They have more colors. You know, it's already, Chinese models are like some of the top selling vehicles in Europe already. They also have, what's the smaller one with the four letters? Anyway, it's not just BYD, which is formidable, but there's other Chinese automakers as well. And you read about these are not like, you know, low cost, cheap businesses. BYD is like, it's like the Japan of the 2020s in terms of the impact that Japanese automakers had on the market back then. So you do wonder if Tesla, even having an advantage to the big three, how does it not get undercut? And if they keep the Chinese cars out of this market, maybe it'll be fine. But how does it not get undercut?
Look, this is an arms race. I mean, this is a Game of Thrones that's going on. And you see what happened in China. I've seen it firsthand. BYD, NIO, Xpeng, and others. I mean, it's some of the best EVs out there. I think where Tesla has been so successful is because of their ability to expand gig in terms of Shanghai, what they've been able to do from a price perspective. And the Chinese consumer, especially in the high end or rising middle class, they do want Teslas. But to your point, do Chinese EV vehicles come here into the U.S.? Ultimately, that actually becomes the issue because that's going to be.
What do you think will happen? If you have a second Trump administration, there will be presumably tariffs or protections against the importation of Chinese vehicles. I would guess. I don't know.
They're still on him from his first administration.
Well, yeah, they're still on it.
Yeah.
I think what's happened right now. Look what's happened out of the Beltway, Detroit Big Three. I mean, it's been gut punches from UAW. But now, if you ultimately have Chinese EVs come in, that would just add to the worry. So I continue to see that as a cement wall that does benefit Tesla, benefits the big three. But right now, they're in that cage match with the UAW, where, in my opinion, that's really the frustration that's building, not just in Detroit, but across the industry.
It seems the one missing plank for Tesla would be if they had a Model 2 or some kind of lower cost mass market car that could compete against the Chinese or just make it more affordable for a lot of Americans who might be tempted to switch. But that feels like it's just way off in the distance at this point.
But I believe by the end of next year, a sub 30K vehicle is introduced by Musk, plus with Cybertruck. And that's why I just view this is in the early days, even with Supercharger and the sum of the parts. This is not an auto company. This is a disruptive technology company. That's why we're buying here, despite what I'll call definitely nothing right home about type of 3Q delivery number.
All right. Dan, thanks for now. We appreciate it. Dan Ives.
Now, Morgan Stanley put out this note today. It says Q3 delivery miss plus a warning on too fast EV adoption. They continue to rate the stock overweight with an inline industry view and a $400 price target. They go on to say that Q3 Tesla deliveries miss Morgan Stanley's estimate of 465,000 on factory shutdowns, while Tesla reiterated its full-year target of around 1.8 million units. Morgan Stanley at 1.86 million units. Separately, we're hearing increased feedback from fleet managers and franchise dealers on the downstream challenges of rapid EV adoption. Goes on to say that EV growing pains from the downstream. From our more recent and ongoing discussions, we are hearing an increased number of anecdotes from executives and other subject matter experts downstream in the field around some of the practical challenges of enabling rapid EV adoption in the U.S. market. While we expect a continued clear increase in EV adoption in the U.S., we note that our forecast for 9% U.S. EV penetration by 2025 and 25% by 2030 continues to be well below consensus expectations. We anticipate the friction cost around EV adoption to get greater amounts of attention throughout the end of this year. So basically they're saying here that the markets might have too high of an EV penetration target for adoption rates for EVs, that some people might start to come to terms with a slower EV growth rate than what maybe we're expecting right now. Morgan Stanley says one of these reasons is collision repair. I was speaking with a car rental licensee who reported the experience of a body shop repair cost for some EVs being 3 times a comparable ICE vehicle, a function of 1, the technical expertise in the field to handle more exotic repairs, and 2, a current inability of EV players to manage the flow of repairs in a timely manner. Hertz has spoken to challenges it has faced in terms of unexpectedly high expenses related to repair costs for its EV fleet. Approximately 10% of Hertz American fleet is Tesla. I've also heard this before from my one buddy that he used to work at a Tesla like dealership, if you will, dealership. Like actually doing these repairs, and he said that's the one reason why he does not want a Tesla, is because the price of getting repairs on a Tesla is way more expensive for the same exact repair on any other vehicle. So that's kind of my experience on this. I don't know too many other people that have Teslas. I've found that you don't really have to service it a whole lot. So if you think about like getting your brakes done or oil changes with an ICE car, it's probably net pretty comparable as far as your actual service cost, including just regular maintenance and, wear and tear. But that's something that I have personally heard. Now, insurance, conversions or conversations with dealers and other counterparts speak to challenges experienced with some insurance companies with respect to EV underwriting due to unpredictable / higher physical damage loss ratios. And then franchise dealer anecdotes. From our Laguana experience, both PAG and GPI commented on decelerating EV sales momentum and rising inventory. Despite a sharp increase in incentives, other issues cited include difficulty in getting permission for high-speed chargers and a lack of trained technicians. Now, obviously, Tesla does not send their vehicles to dealerships, but yeah, that's true. A Ford, GM, these other producers of EVs, there's not enough demand for those vehicles. They sit on dealership lots a lot longer. Tesla, I would argue, does not have that same problem. Morgan Stanley goes on to say that Tesla and a potential ZEV credit IRA market corner. Unless rules and EV mandates are revised, Tesla may find itself in a dominant position in at least 2 ways from a regulatory credit perspective. Number 1, favorable share of supply versus demand for the sale of zero-emission vehicle credits to other OEMs that may not make as many of their own ZEV vehicles as they had expected. And number 2, a disappropriate share of IRA benefits in the U.S. market, particularly of Rule 45X PTCS, in the event that rival OEMs are unwilling or are unable or unwilling to invest in U.S.-sourced battery supply. Morgan Stanley's Tesla model includes just over $1.4 billion of regulatory credit revenue, on average of $760 a unit at 100% margin. We phased down our average per unit regulatory credit revenue to $230 a unit by 2030, but growth in overall units takes total regulatory credit revenue to $2.75 billion by 2030. Our longer-term exit auto margin assumptions for Tesla exclude contributions from the sale of regulatory credits. And this is Tesla's regulatory credit revenue forecast. It's basically going down per vehicle, the amount of the credit, but the amount of vehicles is increasing, so the overall amount of credits will still be increasing. And don't you love a little drawing here? EV penetration percentage. Morgan Stanley thinks we're about here, so it's going to be up a little bit more, kind of sideways, and then you're really going to see the S-curve start to get a little bit more dramatic in the coming years. They think EV penetration will rise, but not in a straight line. And then finally, they go on to share some risks to the upside and risks to the downside. They say our price target of $400 is comprised of 6 components. $102 a share for the core Tesla auto business on 7.6 million units by 2030. 9% WAAC, 13 times 2023 or 2030 exit EBITDA multiple, exit EBITDA margin of 17.4%, Tesla Mobility at $81 on DCF with 600,000 cars at $1.8 a mile by 2030. Tesla as a third-party supplier at $41 a share, energy at $48 a share, insurance at $9 a share, and network services at $119, 23.8 million MAUs, $180 ARPU by 2030 at a 50% discount. So that sounds like a lot of gibberish, but basically taking, hey, what's the margin? How many vehicles are they producing? Taking into consideration the insurance business, which energy at $48 a share, I think that could be a much larger contributor to Tesla's just overall numbers, especially by 2030. And they're taking all of this into consideration. They're giving it, let's see, I believe it's a 30 times multiple, they say here, a 13 times EBITDA multiple, and they're giving it a 50% discount. So it's pretty conservative if I were to say so myself. Now, this is a 12-month price target, and I think that's important to note. Now, risks to the upside. This could mean catalysts that could cause Tesla stock to rise potentially more than $400 a share. Disclosure on service revenue, increased FSD attach rate, cost milestones on new battery, new model introduced, the Cybertruck, Multivan, and the Semi, third-party battery win, geographic penetration, and new capacity. That could be a new factory. That could be, Giga Mexico coming online faster than expectations, or maybe even like getting their vehicles into India. That could be geographic penetration. The risk to the downside: number one, competition, legacy OEMs / Chinese players, and big tech. Execution risk, multiple factory ramps, things could obviously go wrong. Market does not recognize Dojo-enabled services opportunity, lower than expected attach rate, and RPU. China risk, dilution, and valuation. So I think all in all, I think Morgan Stanley says it quite well. This is a pretty conservative price target, and I think a lot of you guys would agree with that. Now, the last thing that I want to share with you here in this video is, again, to the point that I made earlier, where things just don't look well. This photo comes from the Bear Short on X, and this is the Russell 2000. Now, the Russell has not participated at all in the rally in 2023, like at all. But when you actually chart this out, you were in an uptrending wedge. Well, recently you've broke under that, you tried to retest it, and you fell even lower. This could be, as they put it on X, a bad sign for the overall market. The Russell was down almost 2% today. If the Russell cannot do well, then a lot of your other kind of parts of the market probably are not going to do well also. So this is kind of a bad leading indicator for more downside to come. But I'll tell you right now, I think one of the most important things for you guys to be watching is the dollar. Now, the dollar soared today and continued to soar. If you look at 2022, this was 2022, where my cursor is. This was the start of 2022. The dollar went crazy. The dollar increased like 20% in 2022. Now, why that's important is because, again, I'll use the same analogy I made in the last video. If you sell an iPhone for $1,200, just call it that, and in China it's 30,000 won, let's just call it that. Well, that iPhone is still going to be 30,000 won year after year after year. It's not going to change unless Apple raises their prices. The conversion ratio does not make prices for the iPhone go up or down. It stays 30,000 won. Well, you're 30,000 won. If the dollar is super high, then that might only convert back to $1,000 instead of $1,200. If your won is really low, that might actually convert to $1,400 instead of $1,200 because the conversion ratio, the dollar is weaker. So the dollar can help or hurt company earnings. Long story short, the higher this chart goes, the more the dollar hurts your multinational companies' earnings. A Tesla will be affected by this. An Apple will be affected by this. Your largest companies in the world will be affected by the dollar. So the higher this goes, the worse off. And I would argue the dollar was one of the biggest reasons why markets had a really bad 2022. Had nothing to do with bonds, interest rates, had nothing to do with the Fed or any of that. Well, it did. It did, right? Bear with me. For the most part, I would argue the dollar had one of the largest outsized effects in a negative way to our markets in 2022. So if the dollar continues to rally, couple that with some bad data reports or really good data reports, and the markets could be in a very bad position. Now, I do think for Tesla specifically, a breakout into the $300 range is all but certain. I think the catalyst to get us there might be the Cybertruck, and that delivery event could be announced here in just the next couple of days. If not, I would imagine some point in the month of October, we will get that news. So, that is all I have for you here in this video. We covered a lot. I hope you guys learned something. If you did, hit the like button and subscribe to the channel. If you guys want to take it a step further and come trade with us live in real time, I send out trade alerts every time I make trades at all, whether it's buying stocks for the long term, buying Tesla, making some YOLOs, right? Some earnings, gambles, or just long-term kind of upside trades or short-term hedges, long-term hedges. We do it all. Link down below in the description of this video. Thank you for watching. Enjoy the rest of your day. My name is Michael Tyler, and I will see you in the next one.